Okay, well, I've been given the green light to go ahead and get started. So good morning, everyone. This is the GASB session. I'm Simon Keemer. I'm a director in the assurance department. I actually lead our governmental practice, which deals with GASBs. So hopefully you're all here because you want the GASB update. So there's kind of a list of objectives we're going to go through today, looking at a quick overview of the standards, look at what the GASB's got coming up in the future, a few lease accounting reminders, the new auditor's report, and then some changes to the federal audit clearinghouse that are coming down the pike this year. So looking at accounting standards that are going to become effective for us over the next few years, I've added 2021 up there just in case we have anybody that is a December 31st, 2021 year end, and maybe they're still going through their audit. In essence, this is cumulative. So everything on these next couple of slides shows you when an accounting standard, the first period that an accounting standard becomes effective. So there's all the standards that became effective June 30, 2021. If you're a June 30, 2022 year end, then these will all become effective for you at your June year end. So if you're June 30, 2022, as well as all of those for the December 31st, 2021, you'll get all of these new standards becoming effective for the first time in June 30, 2020, then the December 31st, 2022s, the June 30, 2023s. In terms of GASB 92 and prior, I'm not going to go through any of those in detail. We'll look at leases a little bit later. 89, basically saying no longer capitalize interest during a capitalization period. 91 was with regards to conduit debt. 92 was an omnibus standard. The omnibus standards are just a variety of issues that are not big enough in and of themselves to warrant their own standard. Okay, this thing is still being freaky. Okay, so GASB 93. As you may be aware, the London interbank offering rate, or LIBOR, came under criticism a few years ago. It was decided that that as a rate could be manipulated, and so the banking world decided to move away from IBORs and move to what's become known as SOFRs, secured overnight financing rate. So with IBORs going away, that presented some problems with regards to hedge accounting, because hedge accounting basically said if you have a debt agreement that you modify it, you could end up basically having to stop hedge accounting and to redo it all. So 93 came out to basically make the process simpler and basically said, if you've got debt that's LIBOR and you've got a hedge based upon that, if the only thing that changes is the rate, you don't have to go through all of the complex calculations in terms of terminating the hedge agreement. There's a few criteria you need to comply with, but if you have a hedge that's based upon LIBOR and then that gets changed to something other than LIBOR, this is going to give you kind of an easy out so you don't have to terminate your hedge accounting. 94, we're going to spend a little bit of time on 94. In essence, we had Statement 60 from a few years ago that dealt with service concession arrangements, and then they issued GASB 87 for leases. Those two standards together kind of caused a couple of problems. The first was there's a gap between them, where you could have an arrangement that is not really a service concession arrangement and is not a lease, but it's kind of like those, but it fell through this gap. The other issue they had was that GASB 60 was written a few years before GASB 87. So when they wrote GASB 87, they kind of wrote it in a way that FASB had been looking at leases for 842. So they brought in a whole new barrage of terminology for leases and GASB 87. And once they'd done that, they then kind of stepped back and said, well, hang on a minute, we've now got service concession arrangements in 60 and leases in 87 that should kind of work in tandem. But the terminology in 60 is so different to 87 that you can't really see how they would work together. So they decided that they would issue 94 to basically fill the gap and then improve statement 60 for service concession arrangements, and then bring all of the arrangements together with the same terminology. So that is in essence what 94 is doing. And I think we're going to see as we go forward, more and more agreements being created that are going to fall under 94. So when we look at P3s, public-public or public-private partnerships, they're known as P3s. Basically, P3s, they said in 94, fall into three buckets. There's a bucket of P3s that basically meet the criteria of leases and are covered by GASB 87. So their first cut, if you will, of the pie is they said, if you've got a P3 that meets these criteria, it's in essence a lease, so you follow the GASB 87 rules. So then they said the next bucket is P3s that are service concession arrangements. And then the final bucket is P3s that are neither a lease nor a service concession arrangement. And we'll get to those two in a bit. But in essence, they said that first bucket, if it meets the criteria of a lease, follow GASB 87. They also tacked onto it APAs, availability payment arrangements. So the overriding definition of a P3 you can see up there on the slide. It's in essence where you are going to transfer the control of the right to operate one of your assets if you're the transferor. And in my kind of comments today, I'm going to assume that you guys would be transferors, not the operators, because I think in most cases, as colleges and universities, you're going to be the ones that have the asset, if you will, and you're going to go out and get a third party to operate it. So if you're going to transfer control over to the third party, you're going to be in the P3, because for a P3, you actually need to convey the right to control the asset. So they're going to get to control it. It does have to be in an exchange or exchange-like transaction, the same way as GASB 87 was. So, under GASB 87, if you're leasing land, a whole bunch of land for like $1 a year, that's not an exchange or exchange-like transaction. So that would not be a lease under GASB 87. They've applied that same concept in 94, that if you're doing something for like $1 a year, that is not an exchange or exchange-like transaction, so it does not fall under Statement 94. So that's your P3s. APAs, you can see with availability payment arrangements, the key difference is you're going to continue to control the asset. And you're going to continue to control the service capacity of the asset. So any fees that asset generates are going to come into the college or university. You're going to get to control the use. But what you're going to do is you're going to make payments to somebody else to operate that for you or to maintain it for you. So if you will, you're going to maybe say, okay, you've got a parking lot. If you take the parking lot and you say, okay, third party, I'm just going to give you the parking lot. I want you to do everything with it. You manage it, you operate it. That's a P3. But if you say, no, all I really want you to do is do the maintenance on it, maybe you're going to provide the personnel, the third party is going to provide the personnel to operate the gates or something like that, but you're still going to control the asset, you're still going to own the asset, then that would be what you pay the third party would be an availability payment arrangement. And that's the easiest to account for. You keep the asset on your books, and literally as you make the payments to the third party, you will expense them. So let's look a little bit more at the P3s. So as I said, the second bucket for P3s was service concession arrangements. And hopefully you can see here that we're kind of in this middle ground between outsourcing everything, which would be a P3, outsourcing nothing and just paying somebody to manage it for you, which would be an availability of payment arrangement. A service concession arrangement kind of sits in the middle. So the third-party operator, they're still going to collect all of the fees from the third party. So in essence, they're going to retain that risk. So if we go back to the parking lot, if the parking lot is not used and generates zero revenue, that's a problem for the operator. That's not going to be a problem for you as a college. That's their problem. So they have kind of the rights and rewards of that. But in terms of the asset, you're not going to give them full control of that asset. You're still going to control that asset. So you're going to determine who can use it, what the charges are for services. So maybe to use a different example, you've got halls of residence. Is that the right term for colleges? Halls of residence? Okay. Or dorms, that's the word, dorms, there we go. That's the American version. Halls of residence, that's what I'm used to over in the UK. So you've got dorms. And what you could say is, I'm going to give you control of the dorms. You're going to collect the fees. I may be the payment arrangement as the college. I may collect the money from the students, but I'm just going to pass it through to you. So I'm just a collection agent. I don't have the risks and rewards of the revenue. The operator does. But I'm going to insist that anybody that leases a room in that dorm is a student of my college. You cannot go get somebody off the street and say, come lease a room. They have to be a student registered with the college. Oh, and guess what? I am going to set the rate that my students pay, not you. So because the college is within that number two, that you're still really controlling a lot to do with the asset, and all you're really giving the third-party operator is the right to collect the money and keep the money, then that's going to be a service concession arrangement. That's not going to go all the way to a full P3. And you're probably at number three, you're still going to have some kind of residual interest. So you don't have to own the asset. The college doesn't have to own the asset during the term of the agreement, but there would be an expectation that maybe after 30 years, that dorm is going to come back to the college and it will become your asset. So that's in essence a service concession arrangement. And then anything else is just a straight P3. And so how we're going to report it, again, is going to be a little bit different depending on whether your P3 is a service concession arrangement P3 or it's in the P3 that is neither a service concession arrangement nor a lease. Because remember, if it meets the criteria of a lease, we're going to go default back to GASB 87. 94 only deals with something that doesn't meet the criteria of 97. So on our balance sheet, our statement of financial position, we're going to have a receivable for all of the payments that we're going to receive, and we're going to discount those at present value. Okay? If we own the asset and it is not an asset subject to a service concession arrangement, then our receivable will also include the asset that's going to come to us at the end of the agreement at the carrying value we expect that asset to have at the end of the agreement. Okay, so remember, for a full P3 that's neither a service concession arrangement or a lease, we don't actually have the asset on our books, okay, because we have transferred that to a third party, or they are going to build something on our behalf. So it may be they are actually going to build the dorm, they're going to operate it for 30 years, and then at the end of 30 years, that's going to transfer back to the college, okay? So if it's going to transfer back to the college, then in our receivable, we're going to include what we think that future carrying value is going to be, and that's going to go into the receivable, and then we're going to have a deferred inflow that basically keeps everything in balance when we first start. Because when we first account for this, we don't really want to have a big adjustment to net position or a big gain or loss in our statement of activities. At the start of it, we want kind of the balance sheet to be in balance. So we recognize this receivable and we have an equal and opposite deferred inflow. Then if a new asset, so let's say we're in the situation where the third party is going to build the dorm. So what do we do with that new asset? So as I said, if the P3 is not a service concession arrangement, that's the asset that would go into the receivable at the carrying value as of the future date when we will get ownership. If the P3 is a service concession arrangement, then we're going to capitalize that asset. Because remember, for a service concession arrangement, we still are going to have control over the asset. We still get to control on that dorm, who lives there, what the rent is. So because we're still controlling it, we're going to recognize that asset on our books for a service concession arrangement. So this gets really quite complicated in terms of which bucket you're in. And in analyzing these, it's going to become very specific to wording in the agreement. So, for example, when the asset comes back, kind of like a lease, where it said, well, do you have a lease or do you have a financing arrangement? GASB 87 said, well, if the asset transfers at the end of the lease automatically, then it's a financing arrangement, it's not a lease. But if there is a payment that needs to be made at the end of the lease, then that is an automatic transfer. Even if that is $1, it's still not an automatic transfer, so it would be a lease. And hopefully, if anybody's looked at GASB 87 from a lessor perspective, you're going to see that what's on this slide in terms of the accounting is very, very similar to what a lessor would do under GASB 87. So we've had some questions along the lines of, well, how is it going to look different in each of the buckets and which one's going to make my balance sheet look better? In essence, unless you're an availability payment arrangement, which is a simple one, ignore that. If you're in a P3 or a lease, the concept they were trying to get for this was that everything would look very similar, but it would just be some geography on the balance sheet. So, you know, if we look at the bottom in terms of a new asset, that asset is going to go on the books, but under a P3, it will appear as a receivable, but under a service concession arrangement, it's going to appear as an asset. Under GASB 87, it would appear as a right of use asset, an intangible asset. So what they're trying to do with 94 and 87 working in tandem is to come to similar conclusions, but just the geography looks a little bit different depending on what situation you're in. Okay, continuing the trend, we get to 96, which is speeders. Speeders came around basically because if you look at GASB 87, GASB 87 says it has to be a tangible asset. So it's got to be something I can physically touch. So then the question came about, well, hang on a minute, there's a lot of entities that are in essence leasing. If you apply a GASB 87 thought process more generally, there's software out there that we lease, but software is not tangible. So that doesn't fall under GASB 87. So what do we do about those? So GASB 96 came along for subscription-based information technology arrangements, speeders. In essence, it takes the GASB 87 language and it applies it where you've got an arrangement where you're using another party's IT. So we've had one of the questions we've had is a software that is providing news articles and magazines, is that a speeder? So the question then comes is, well, what is the software that you're using? Is it literally a software that shows you the New York Times online or the Wall Street Journal online? If that's all it's doing, that's probably not a speeder because you're not really using their software to do anything. But let's say, for example, their software then allows you to do search functions in there. So a student who's doing a research project could put in some keywords and it's going to provide them with articles from the New York Times, the Wall Street Journal, maybe trade publications. Well, now we're a bit more complicated and maybe now we do have a speeder because we are actually leasing that third party's technology to do those searches. Okay, so again, it can get very complicated based upon the actual wording of the agreement and what you're being provided with. It comes down again to the exchange or exchange-like transaction. So if that software was being leased to you for $1 a year, it's not going to fall under GASB 96 because that would not be considered an exchange or exchange-like transaction. But if you do have a speeder, it's going to account for it exactly the same way as we did for GASB 87 for tangible assets. You can see they kind of came up with an idea and it's like, let's just keep using this idea over and over and over again for different situations so that we make sure our terminology is consistent and our accounting is consistent. And to a degree, it's going to stop somebody from trying to get around the rules. I don't like GASB 87. It's really difficult to implement. So if I structure the deal this way, then maybe I can get around 87. What they're trying to do is kill that loopholing and try to apply the concepts that they came up with in GASB 87 to all of these various scenarios that you could get into with your contracts. 97. So GASB 97, in essence, dealt with a bit of a problem that GASB 84 and Implementation Guide 2019-2 created. So, there was a lot of discussion about fiduciary activities and how we need to move fiduciary activities. And then they talked about in Implementation Guide 2019-2 about what you should do if you don't have a governing board, if there's no governing board, but the government's acting like the governing board, then that's the same as basically getting to like put in place a majority of the board. So they did all these fancy rules for fiduciary activities, and then probably some bright spark in the back of the room put their hand up and said, well, hang on a minute, what about defined contribution plans? Because a defined contribution plan is going to meet Statement 84 in terms of we're legally obligated to make contributions. And that defined contribution plan, it doesn't have a board. We're the trustees. So are you saying, like, all of our defined contribution plans, we have to put them as fiduciary activities in our financial statements? So basically, 97 came along and basically added the word except for. And it said, you're going to follow those, you're going to follow the rules in those standards, except for defined contribution pension plans, defined contribution OPEB plans, or other defined contribution employee benefit plans. If they are defined contribution, you don't need to treat them as fiduciary activities. Ignore the previous guidance and just go along with expensing as you incurred with some disclosures about the defined contribution plan, but certainly do not include them as fiduciary activities. While they were going about dealing with that issue, they decided in their infinite wisdom to just throw Section 457 plans into the same standard and basically said, if you've got a Section 457 plan, you should classify it as a pension plan, or you should look at it to determine if you need to classify it as a pension plan or an other employee benefit plan. And if it meets those definitions, then go ahead and treat it the way you would a pension or an OPEB plan. 99 is Omnibus 2022. So in essence, as I said, the Omnibus plan, the Omnibuses are just a whole morass of different topics where they're not enough to form their own standard. So when GASB issues a standard, they will then get lots of questions coming in. And they keep a list of those questions. Some of those questions, they decide, you know what, the answers to this would be so pervasive and so important, that question deserves its own standard. The rest of the questions, periodically, they will say, okay, the list has got so long, we should answer all these questions formally, and we put it in an omnibus. GASB has issued an omnibus annually for the past 2 or 3 years. That is not their definition of an omnibus. That is a little outside of what an omnibus should be in their minds. So they are saying Omnibus 2022 will be the last of the annual omnibuses. Is that the, I guess that's the plural of an omnibus. Is it an omnibi? This is the last of the annual omnibi. And they're going to go back to being much more infrequent after 2022. So what they dealt with in 2022, financial guarantees. If anybody has financial guarantees, they identified that they had GASB 62 for financial guarantees that are exchange transactions, and they had GASB 70 for financial guarantees that were non-exchange transactions, and they used completely different terminology. And so, in essence, in Omnibus 2022, what they've done is they've said, okay, we're kind of going to get rid of all the terminology that's in GASB 62. We're going to apply the same concepts that we had in GASB 70. So the terminology is now going to be the same, whether we have exchange or non-exchange financial guarantees. Other derivative instruments. This is a fun one. In essence, where they ended up was they said, okay, we've got a whole bunch of derivatives that people are using to generate income. And then we've got a whole bunch of derivatives that people are using to hedge maybe their debt. But the hedging accounting rules only work if the hedge is effective. So what happens if my hedge becomes ineffective? I now end up in another donut hole because I'm not holding that hedge in order to generate income. And you've told me I can't apply a hedge accounting because it's ineffective. So what do I do in that situation? So being the innovative individuals they are at the GASB, they came up with a whole new class of derivatives that they called other derivatives. And so in essence, we now have 3 classes of derivatives. We have those derivatives that you have to make a profit. You have those derivatives that are effective hedges and do hedge accounting. And then everything else is an other derivative, and you would apply the rules that are in Omnibus 2022. They did do some changes to leases, P3s and speeders, which we'll look at in just a minute. They dealt with the extended use of LIBOR. In essence, when the powers that be in the banks decided that LIBOR was going away, they said they were going to sunset that on December 31st, 2021, I believe. And surprisingly enough, they got close to December 31st, 2021, and were like, yeah, we're not going to sunset this right now. We're going to let it hang out there for a bit. Well, the GASB had written their standards based upon LIBOR sunsetting December 31st, 2021. So in the Omnibus 2022, it basically gives you some rules that say, okay, we now know that LIBOR is not going to sunset on a specific date. They've told us a specific date, and we don't trust them anymore with their dates. So in Omnibus 2022, they've kind of said, whenever LIBOR goes away is the change they've made. And they've been much more vanilla, shall we say, on specific dates. And then there's a few technical corrections and updates that are very specific that we're not going to get into. So let's look at what it did in for leases, P3s, and speeders. So there was some inconsistency within GASB 87 with regards to termination clause language. So it's clarified termination clause. They clarified, and we've had this question a few times. What happens if we have like a lease that can be terminated by either party without, the agreement of the other? Is that a cancelable period? Is that a non-cancelable period? So they clarified that. So when you're applying GASB 87, you have to look at the non-cancelable period of the lease. And you ignore, to a degree, the cancelable periods in the lease. So what they said was the cancelable periods also include any period after both the lessee and lessor have the option to terminate. So if your agreement says this lease is going to last for 6 months, and then after that, it can be terminated by either party at will, your non-cancelable period is 6 months. Even if this lease says it's 3 years, it's a 3-year agreement, but 6 months, non-cancelable. After that, either party can cancel it with 30 days notice. Then technically your non-cancelable period is just the 6 months, or it could be 6 months plus the month notice that's required. The rest of the 3 years would be regarded as a cancelable period. The other thing they dealt with was short-term leases. So they said, well, what about the situation where I have a 9-month lease at the start, and so I treated that as a short-term lease and didn't do lease accounting for it, okay, because it was a 9-month lease. 8 months in, we signed a modification to that lease that extended it for 6 months. That's another short-term lease, isn't it? Because it only lasts 6 months. And the GASB has stepped in and said, no, that is not the correct way to account for it. When you're analyzing a short-term lease that's been modified, you have to go back to lease inception. So if you had a 9-month lease that after 8 months was then extended out another 6 months, that's a 15-month lease. And a 15-month lease does not meet the definition of a short-term lease. So as soon as you get that modification for the extra 6 months, you now have to treat it under GASB 87. Okay, now you would only have 7 months of that lease left. So when you do the accounting, you would do accounting for only 7 months. You don't go back to lease inception and try and do prior period adjustments and all of that. You just start from the date of the modification onwards. But you do have to consider back to inception of the lease to decide, is it still a short-term lease? So what's on the horizon? What do we have coming down the pike from the GASB? So this summer, we are expecting a standard on compensated absences. This might be of particular interest to this group because within compensated absences, they are looking at concepts such as sabbaticals, as well as your normal paid time off. So within the compensated absences standard, they're trying to make it as widespread as possible. So they are grabbing any type of paid leave that you can think of. So if you've got vacation and sick time separated, they deal with that. If you've got rid of vacation and sick time and you just have paid time off, they're dealing with that. Sabbaticals, they're dealing with that. I think the only thing in that final standard that's likely to be scoped out is something like military leave, if you allow people to go off and work with the military. But every other type of compensated absence, if somebody is not going to be at work, but you're still going to be paying them, the compensated absences standard should cover that scenario. We've got accounting changes and error corrections. They're going to issue a standard on that. It's going to be very similar to the GASB approach. So they're going to, in that standard, there's going to be the different buckets of, are you correcting an error? In which case you're going to go back in time. It deals with how you would deal with correction of an error in supplementary information and required supplementary information. It deals with if you're changing accounting because there's a new standard issued that you're converting to, if you're changing accounting to go from one preferred method to another preferred method, if you're changing an estimate. It's going to deal with all of those types of issues and set out those buckets so you'll be able to say, okay, this is what I've got. What bucket does it drop into? And then it's going to tell you, are you going to do retrospective application or are you going to do prospective application? We're expecting a new conceptual framework on disclosures. The conceptual framework is in essence what's used by the GASB when they set a standard. So when they are drafting a standard, they draft that standard based upon the concept statements. We don't really use concept statements in financial statement preparation because the concept statements are so far down the hierarchy that we rarely need to go all the way down to concept statements. In terms of the concept statement on disclosures, they are using a term they call essentiality. I'm not 100% sure that's a word that they haven't just created, but they're using this concept of essentiality. So when they draft any future GASB, any disclosures in that GASB have to meet the criteria that they are essential to a user. So that's going to lay out, in essence, what essential means in a GASB world. They're saying it's going to make disclosures shorter. Yeah, like the IRS continues to do tax simplification. Risks and uncertainty disclosures, we're expecting an exposure draft in the summer. So again, that's going to be disclosures about risks and uncertainties. It's looking like in that exposure where they're going to go is they're going to go down the route of constraints. So what are the constraints on your net position or your fund balance? And then what uncertainties do you have in estimates and things like that? Another exposure draft in May on non-financial assets. We'll see what they put in that. And then other areas that they're working on with no real defined dates. They've put some stuff out there, but who knows if they'll meet those dates on going concern and financial stress, conceptual framework in terms of recognition, the financial reporting model re-examination. This is the one you've probably heard people talk about in terms of fund financials, governmental funds, how they're going to change those to maybe not be this modified cash, modified accrual basis that they have right now. And then the one that scares a lot of us in practice, revenue and expense recognition, because every time the GASB talks about revenue, they feel the need to mention ASC 606, which is the FASB standard for revenue, which was an absolute nightmare, and trying to apply FASB ASC 606 into a government world is going to be really interesting. So we are watching that one with interest. They do post-implementation reviews. So this is basically whenever they've issued a standard, if they think the standard has complexity to it, that people could take different routes, they do post-implementation reviews to see how consistent financial statements are in terms of the application of the standard. And they are the 6 standards that they are watching right now in terms of PIRs. So a few lease accounting reminders. So if you're a lessee, I think everybody knows we're going to have a right-of-use asset and a lease liability. Interest expense is going to be recognized as the lease liability is paid down, and we're going to amortize the right-of-use asset. If you're a lessor, you recognize a lease receivable and a deferred inflow for the lease revenue. Sounds a lot like we talked about in terms of P3s and service concession arrangements, that receivable and that deferred inflow. And then you're going to recognize interest and lease revenue over the course of the agreement. In terms of identifying leases, that inventory of leases is critical. When you get audited, your auditors are going to pay a lot of attention to that inventory of leases, and they're going to want that to be as complete as you can make it. The more leases your auditor finds that weren't on that list, the more trouble there's going to be getting through your audit. So make sure you're spending a lot of time on that lease inventory. It can be very time consuming. It's going to involve a lot of departments outside of finance. And making sure that you're looking for those embedded leases. The example we've previously given is things like a phone service where you're paying monthly for the phone service, but you're getting the phones for free or at a highly discounted rate. That would be the leasing of the phones would be an embedded lease. And so you would actually have to identify what portion of that phone service needs to be pulled out of the phone service and treated as a lease of the phones. Remembering that GASB 87 only applies to material items, you need to look at that both from an individual lease perspective, but also an aggregate. So if you've got copier leases where you're like, well, I'm leasing it for $100 a month, that can't possibly be material, so I'm just going to ignore that. And then you do that for the next lease and the next lease. And you're still doing that on the 500th copier lease and then the 600th copier lease. By the time you get that many and you add them all together, you could then have to stand back and say, well, hang on a minute, each individual copier lease is not material, but when I look at the whole portfolio of copier leases I have, they are material, so I am going to have to treat them under GASB 87. And it's not on the slide, but I've already mentioned it a couple of times. Remember, it's also only exchange or exchange-like transactions. So anything you're leasing is clearly not an exchange-like transaction, then you can leave those off. I would say still put all of those on your lease inventory. So you can say to your auditor, yep, we identified it, we considered it, and then you can put next to it like not material or not an exchange-like transaction. So you can say to it, yep, we considered it, and this is why we're not doing all of the fund calculations. At least that way your auditor is going to be confident that your lease inventory is complete. So then you want to make sure you're looking at those short-term leases. So it's anything with a maximum term of 12 months. Remember, on short-term leases, you don't consider whether you're going to take up the options or not. So if you've got a lease that is for 12 months, but has an option to renew for another 12 months, even if you're like, there is absolutely no way we are ever going to take up that option, it's still not a short-term lease because the maximum possible term is 24 months, okay? On the lease term of other leases, make sure you're paying attention to that cancelable versus non-cancelable term. So you're only going to include in the non-cancelable portion of the lease, okay? And then the cancelable portions, you're going to look at how reasonably certain are they that we're going to extend the lease, and how certain are we, if it's a termination clause, that the lessor would terminate the lease. There's various tools to help you through the whole GASB 87 calculations. Obviously, Excel is out there if you've got just a few leases. There's some good compliance software out there, Lease Query, Visual Lease. If you're currently a client of Dean Dorton, then we've got some good feedback we can give you on the various options for software. And then just generally us and other CPA firms are offering a whole portfolio of services that are scalable to your wants and needs. So all the way from just helping with lease considerations, all the way through to us owning the lease software and actually maintaining it for you in a similar manner that maybe we do for some of you for fixed assets, that we maintain fixed asset software and we'll maintain your fixed assets. So again, in these conversations, you want to be thinking about, do we want to manage this entirely in-house? Do we want to outsource, co-source? The new audit standards that were required to be implemented at the end of 2021, basically, I'm not going to bore you to death with all of the details of what we're having to do from an auditor perspective, but there are some differences that you're going to see from the auditee perspective as a result of these audit standards. So in essence, if you look at the last 3 bullet points there's going to be changes to engagement letters and the letters sent to those charged with governance to change some terminology and to clarify some items. You're going to see maybe much more in those charged with governance letter. You're going to see maybe more documentation in that letter about what significant risks are, what's been identified, and what the response to those are. There's an increased emphasis on disclosures in the financial statements. So you're maybe going to see the auditors doing a little bit more work in terms of disclosures. And it's basically also heightening our focus on related parties and significant unusual transactions. So again, you may see a little bit more audit work in those areas. In terms of the audit report, this is where you're going to see the biggest change. They have completely changed the auditor's report. They've added a whole bunch of wording. They've changed the order of it. You can see there I've listed out kind of a lot of the changes to the audit report on the next slide. I know that's very, very small, but hopefully just from your distance, you can see, wow, that does look a lot different from the auditor's report that I'm used to seeing, if only because you can see towards the bottom of that, there's bullet points, and we've never used bullet points in an auditor report before. But you will see right at the very top is our opinion. You're used to seeing our opinion maybe halfway down, 3/4 of the way through the auditor's report. You're now going to see that opinion right at the very top. You're then going to see our basis of opinion come next. And then management's responsibilities, and you'll see that's been expanded a little bit to include going concern. And then the auditor's responsibilities is the most expanded section and gives more clarity on our responsibilities within an audit. This is short compared to the employee benefit plan audit report. So any of you that have audits, under ERISA, you're going to see those change, and I'll get to that in a little bit. You can engage your audit firm to report on key audit matters. SEC companies already report on CAMs with a C. A private or not-for-profit entity has CAMs with a K. We only report those if you specifically engage us to do that. You will see changes to any GAGS opinion. So if you have a single audit and you are getting that opinion that's performed, the opinion with regards to major programs in accordance with uniform guidance, you're going to find very similar changes to that report in terms of our opinion being at the top and a whole bunch of additional wording. So look out for that. The yellow book opinion on internal controls over financial reporting, that's not really changing. And as I said, the ERISA audits are going to change as well. And they're also getting rid of this concept of limited scope audit. So if you were having a limited scope and you were used to receiving a disclaimer of opinion from your auditors, that is no longer going to be a disclaimer of an opinion. And it's no longer going to be a limited scope audit. It's now going to be an ERISA section 103A3C audit. Guarantee you, your auditors are still going to say limited audit because who wants to keep saying that other thing? It is going to put more emphasis on you as the auditee in terms of you are now going to have to explicitly state that you have considered whether it's permissible for you to have a limited scope audit. So it is going to be up to you to decide whether the certification of your assets being complete and accurate has been done properly by a qualified institution. That is now your job, and we will audit that decision. So you're going to see some changes in how the audit team interacts with you in terms of the certification. There's also going to be a change in the conversations over SOC reports. If, for example, you're using a payroll company, it's now moved the emphasis over to you as auditees that you are required to review that SOC report. You are required to decide if that is an acceptable SOC report, and you are required to determine that any user controls in that SOC report you have implemented. And the auditors are going to ask you to tell them your responses. Okay, so normally we would go through the user controls and we would say, okay, there's this user control and this is what they do. Okay, we've always done that before. Now the emphasis is going to go over to you, and we're going to say to you, okay, here's the list of user controls in that SOC report. You tell me what your controls are that address every one of those. It's not going to be my determination anymore as to which one of your controls map. It's going to be your decision, and you're going to have to tell me. Okay? Changes to the Federal Clearinghouse. I don't know how many people have maybe seen this. I think it's not been publicized very well. In essence, right now, the Federal Audit Clearinghouse, which is the website where you upload and you certify your data collection form, that is currently within the Department of Census, and it is being moved to General Services Administration. Is General Services Administration just going to take over the current website? No, they're going to have their own website. That's what they're saying. My personal belief is any rational human being would have just picked up the website and moved it over to GSA and let us just keep filing the way we've always filed. But that is not our federal government. And so there is going to supposedly be a new website that is going to go live on October 1, 2022. Mark that date in your calendars, and a few days before it, start looking for the news releases that website is not yet online, because we all know it's going to happen. And so 2021 and prior single audits will still get filed through the existing website, and 2022 single audits are going to get filed through the new website. And Census has said they will allow people to continue to use the existing website after September 30, 2022, just in case there's some old 2021 single audits that need to be filed. But their belief is they are going to be few and far between. And we're not sure how great the website is going to work once we get to September 30, 2022. So if you have a 2021 single audit, get it submitted as quick as you can, and certainly before September 30, 2022. And then 2022, we'll start using the new website. Questions? We are on a break, in the words of Ross Geller. I think it's until past. So we will reconvene at 11:30. Thank you.